Welcome back to Project Pulse. In the previous lesson, we covered the full tolling cases. And what you can see on the dashboard is a stress test where the battery degrades faster than expected. That pushes the augmentation schedule forward, and you will notice that this can pull the DSCR concerningly close to 1.0 in the years before that earlier than expected augmentation kicks in. If you're new to this Deal Lab series, I recommend starting with part 1, where you can download the model start file for free and build the model alongside me. Link is in the video description below. And now let's move back to the information memorandum. We are still in monetization pillar 1, but in this lesson we will switch to the resource adequacy plus merchant arbitrage case. The cases for this lesson are based on a 4-hour battery, whilst in our previous lesson we covered a 2-hour battery. In this lesson we will implement 3 scenarios. The debt base case, where lenders assume a 20% haircut on merchant arbitrage revenues, the equity base case, where we assume no haircut, and one debt sensitivity, where we assume a 1% additional reduction in effective load carrying capability per year. The key concept for this lesson is that resource adequacy is the contracted capacity revenue and merchant arbitrage is the market-driven upside, which is the reason why lenders apply a haircut to their portion of the revenue stack in the debt base case. And now let's move back to the model checkpoint file from our previous lesson. Right now you can see that we are still in case 4. So let's move to our inputs time independent sheet. And we will start with case 5, which is our debt base case, resource adequacy plus merchant arbitrage with a 20% haircut. So let's switch over to case 5. And let's briefly scroll through the inputs and see what's different in comparison to our previous cases. You will notice that we now look at a 4-hour battery right here in row 24. Which means that our installed DC energy at the beginning of life must be double the amount than it was for our 2-hour battery because we sustain the same megawatt AC output at the point of interconnection. Then we also apply a different battery degradation assumption because now we have a merchant component in place which will likely accelerate degradation. We can actually check that time series really quick in our inputs time dependent sheet. And you will notice that our resource adequacy plus arbitrage degradation assumption is right here. And that is indeed a more accelerated degradation curve than in our previous case. So let's move back to our inputs time independent sheet. Scroll down. And here for the revenue assumptions, you will notice that our revenue stack now consists of our resource adequacy contract. And we also have a merchant energy arbitrage component. Here for our resource adequacy contract, you can see this contract is turned on. And 100% of our capacity is actually contracted, meaning the full 200 megawatt AC at the point of interconnection are contracted under our resource adequacy contract. And as typical for resource adequacy contracts, we can also combine that with a merchant energy arbitrage upside. However, that upside is restricted by 2 components. The first one being that our equivalent full cycles for arbitrage purposes per year is significantly lower than it could be with a fully merchant battery. And the second constraining factor is that our arbitrage is constrained by the 4-hour resource adequacy BESS. And the arbitrage itself is constrained here because here in those 3 rows you will notice that our average charge price tends to be slightly higher than in our fully merchant cases. The fully merchant cases being those 2. And our average discharge price tends to be lower. And that's because with our resource adequacy contractual obligations, we need to make sure that our battery is available under the contract when it's needed, which effectively leads to a less optimized charging and discharging path, meaning that the prices for the charging cannot be minimized as much, and the prices for discharging purposes cannot be maximized as much, which ultimately leads to a spread that is lower than in a fully merchant case without any resource adequacy restrictions. Okay, that's for the revenues. Then we can scroll down further. You will notice that for our augmentation, now we do actually restore now 20% of our initial capacity as buffer. And the headroom trigger is now also at 5%. And that is due to the accelerated degradation that we have seen in our inputs time dependent sheet. That just essentially means that we have to now augment our battery more often, and we have to install more capacity to maintain our minimum megawatts AC at the point of interconnection for the full 20 years. Then we can move on to the financing section, where you will notice that our maximum leverage now only sits at 70%, and our tenor is still 15 years. So the reduced leverage is probably justified by now the additional merchant exposure of the battery. So lenders are going to be a little more conservative if there's a merchant exposure component in the revenue stack. And then let's scroll down further. Here in the sensitivity section, you will notice that we have a 20% haircut on our merchant energy arbitrage revenues, but only for case 5, which is our debt base case. So case 6 will be identical to case 5, except that in case 6, which is our equity base case, our equity investors or sponsor will not assume an additional merchant energy arbitrage haircut. So the equity base case will likely lead to higher returns and debt metrics than our debt base case. Okay, let's move back up to the financing section for this case. And you will notice, as in our previous lessons, that our debt sizing case for case 5 is on because it's a debt base case. And for our two sensitivities, we have turned our debt sizing off. So let's for now actually just size case 5. And since we deleted all our debt schedules in a previous lesson, you will notice that these 3 right here are still missing. So let's see what happens once we hit our master macro. And you will see that we now have a debt schedule pasted. Let's move to our dashboard and see what that looks like. First thing you will notice is that we now have 2 augmentations that occur earlier than in the previous case. We have a blended DSCR that sits between 1.3 and 2.0. 1.3 was our sizing DSCR for contracted revenues, 2.0 for merchant revenues. And here down here in the revenue sources chart, you can see that most of our revenues are contracted and we only have a slight merchant exposure, which is the reason why the overall DSCR is much closer to the contracted 1.3 DSCR over the fully merchant 2.0 DSCR. Our levered equity IRR in the debt base case would be at 9.3%, which means we would be below hurdle, leading to a negative MPV of 5.4 million. Then you will also see that the CFETs during our debt term are now split into contracted and merchant CFETs. Most of the CFETs are contracted, 77% are contracted. So we have 320 million of contracted CFETs and roughly 96 million of merchant CFETs. And we can also see that our leverage of 70% is actually not the constraining debt factor, but instead it must be the sculpting with the 1.3 contracted DSCR and 2.0 merchant DSCR. And in our cash flow waterfall chart, we can see our overall debt movements, our debt principal, as well as our debt interest. And we can also see all of these outputs down here in the cash flow summary and our debt schedule and credit metrics. And all of these outputs here ultimately just serve to visualize the business case here in the dashboard. Okay, now let's implement our equity base case, case 6. And the only difference we will have is that we now don't assume a fully merchant haircut. And now I'm going to show you 2 ways of doing that once again. So first we select case 6. Since we have not yet implemented any debt in our inputs time dependent section, and we assume our debt is not sized, that means we shouldn't see any debt itself. So this is basically the asset on an unlevered basis, which is obviously not what we would want for our equity base case. So we want to make sure that our debt schedule for our equity base case is also showing up. So the first step could be that you pick up the debt schedule from our debt sizing case and just copy and paste the values of that case. And then if we move over to the dashboard, you will see that we now have our debt in the cash flow waterfall. You can also see that it's showing up in our DCR right here. And our levered equity IRR has improved significantly. Now, the second way you can implement our debt schedule is we delete this input right here, and then we move back to the inputs time independent sheet where we turn on our debt sizing, and then we will copy and paste our merchant energy arbitrage haircut. So right now we get a warning because we are trying to size our debt assuming a sensitivity. So the model is trying to warn us if that is truly what we want to do. So we could flip back to a debt base case to not get a warning. It doesn't really matter. We can still size on an equity base case. Then we hit the master macro, and you will notice we get the same time series of outputs for our debt base case because the inputs are identical to case 5. And all we have to do then is first turn our debt sizing off so that now in the operations sheet, if we scroll down to our debt section, you will see that we now apply for the term loan principal repayment our hard-coded schedules from our inputs time dependent sheet. And if we just leave that turned on, I want to briefly demonstrate what would happen. We could take off the merchant haircut, move back to the operations sheet, and then you would notice that our calculated live case would now be the applied debt principal. Let's hit our macro. And what you might have noticed is once we hit our macro, our hard-coded schedule from our inputs time dependent sheet shifted up by like $10 million. And that is because now we would have more merchant CFEDs to allow for more debt, leading our inputs time dependent debt schedule repayment to be slightly elevated in comparison to our debt base case. So this is certainly not what we would want to apply for our equity base case because the debt will always be based on the debt base case. So let's undo this, put in 20% right here, hit the master macro, move to our inputs time dependent sheet. And you will see that we now get the same debt schedule, which means that we can now turn our debt sizing off and delete the merchant haircut, which leads to an equity IRR, which is significantly better and now also based on our actual debt schedule from our debt sizing case. Now, what you will notice is that the overall DSCR profile has improved significantly from around 1.4 to 1.5, 1.57. But you might also notice that we have a drop in DSCRs in year 2038. And you might question, why is this happening? And that is because now our SPV becomes more profitable and our tax loss carry forward account that we will see in our integrated financial statements on our balance sheet, actually on our operations sheet, not on our balance sheet. So if we scroll up to our levered taxes section right here in the debt sizing, you will see that we have a tax loss carry forward account, which ensures that we only pay taxes once we actually have a cumulative profit within the SPV, and that in the equity-based case is happening in year 2037. So in 2038, we have to pay full taxes and we don't have any more tax losses that we can carry forward to reduce our tax bill, which in return reduces our CFATs earlier than they would be reduced in case 5. So let's see what happens if we turn to case 5. And you will notice here our tax loss carry forward account is actually reduced in year 2038, while in case 6, it's already reduced in 2037. Now that means in year 2038, our CFATs in our equity-based case are actually going to be lower than in our debt-based case. So here for the equity-based case, we have CFATs of 21 million and we have to pay taxes of 7.3 million. Now if you move over to case 5, which is our debt sizing case, we actually just have to pay 2.5 million in taxes in that year, lifting up our CFATs overall, although our EBITDA will be slightly lower due to the merchant haircut. But the tax effect harms our CFATs more because here we assume that the tax bill is significantly lower than expected, while in the equity-based case that would be higher. And this effect causes the DSCR in year 2038 to be below 1.3, whilst in case 5 we had a DSCR of 1.4 in that same year. Now, as long as the financing is a mini-perm, that might not be a big issue because you would just have after 5 or 7 years a bullet repayment to the debt investors, and then lenders can reassess in a refinancing scenario how the actual taxes are expected to kick in. But this is something to be aware of, and if there's no mini-perm financing structure in place, lenders might want to mitigate that extra tax burden risk with implementing a restricted cash account before that tax bill comes due. All right, now we covered case 5 and case 6. Now let's move on to our final case, case 7. And since we have not yet implemented a debt schedule, it's again an unlevered case. So for this one, let's do it easy and just copy and paste the hard codes right here. Move to the inputs time independent sheet. And you will notice we have an additional sensitivity input in row 304, which is an additional effective load carrying capability sensitivity, which is only applicable to resource adequacy contracts. But just to double check, let's first delete that input and compare whether this dashboard looks identical to case 5, which is our debt-based case. And you will see that the dashboard is the exact same, which means we can implement the sensitivity and see what happens. But before we do that, I want you to be aware that within our secret sauce, concepts like effective load carrying capability and any other BESS related items or project finance related concepts are all covered in detail here. So if you're ever confused about a concept or if you don't know a certain acronym, such as ELCC, you can always read up on these concepts in the secret sauce that is downloadable in the first lesson of this course. And just to briefly cover on ELCC, or effective load carrying capability, this is essentially the share of a battery's nameplate power that the grid operator counts as reliable capacity during peak system stress. So the grid operator pretty much just wants the battery to be a backup for the system during peak demand. So if the effective load carrying capability factor declines over time, the battery earns resource adequacy payments on less accredited capacity, even if the capacity at the point of interconnection hasn't changed. And now that we covered the theory, let's move back to the model. And as you can imagine, this is a really important factor for resource adequacy structures. So although resource adequacy is a fully contracted revenue, there is still some uncertainty associated with the effective load carrying capability factor, which is covered in our inputs time dependent sheet right here under revenue related forecasts. And you will see that due to more and more batteries entering the grid, the resource adequacy ELCC in percent of nameplate reduces over time. So the more batteries we have in the system, the more storage is in the system, the less demanding the peak hours will become, which means the grid operator doesn't rely on as much backup storage anymore, meaning under a resource adequacy contract, batteries might qualify for less and less of contracted revenues. And to stress test that assumption, which here the base assumption will likely come from either an independent engineer or a market consulting specializing in the energy market where your project is located. And to stress test that baseline assumption, we have the sensitivity that kicks in here. So if we jump back to our inputs time independent sheet, here we will add 1%. Let's move back to the inputs time dependent sheet. And you will notice that our applied ELCC, including our sensitivity, is now accelerating even faster than our original ELCC. And let's move to the dashboard and see what that looks like. And you can see that our DSCR profile has worsened quite significantly, but we are still above 1.0 and we are also above lockup. So even if there is an additional 1% per annum in reduction, lenders would still expect to get their money back without any events of default. That has also decreased our levered equity IRR, and we will be able to see all of these outputs in our scenarios output sheet. And we can just hit the master macro here to copy and paste the case 7 outputs. And you will also notice that when we ran our case 6 the last time, we have not executed our master macro afterwards, which is the reason why the case 6 outputs still equal to case 5. So to make sure that all of these outputs are up to date, we can just say run all cases up to case 7, hit our run all macro, hit OK. And you might have noticed that now our resource adequacy case 6 has gone up and the levered equity IRR is now at 11.4%, reflecting the actual equity-based case. So for this structure in our monetization pillar 1, you will notice that our equity still hurdles at above 10%. So we still achieve an equity IRR above 10%, resulting in an NPV of 11.39 million. You will also notice that our duration of the battery has gone up from 2 to 4 hours, meaning our DC energy installed at the beginning of life has also doubled from 530 to 1060 megawatt hours. And overall, this doubling in energy has almost doubled our capex that we need to finance. So we go from 173 to 289. And overall, clearly our full tolling case is still more attractive for the equity investor because the equity IRR is significantly higher. And also from a lending perspective, the overall cash flow profile and DSCR profile for the full tolling case is much more certain than a combination of merchant arbitrage plus resource adequacy, which we modeled in this lesson. Alright guys, this was it for this lesson, and in the next lesson we will finish monetization pillar 1 by moving to the final set of cases under an auxiliary services contract in combination again with merchant arbitrage. Alright guys, I will see you in the next lesson. See you there.